Hi, this is Michael Carlin, president of Henry & Horn Wealth Management with your Manage the Funds podcast. We're going to do the easily digestible version, and it's got to be on a topic that is coming up every single morning, every day, any finance article. It's either the number one article or it's certainly in the top couple. It's the yield curve and the inverted yield curve. I end up spending a good portion of my day now educating clients over and over again about what the yield curve is and what an inverted yield curve is. So what I thought I would do is spend hopefully the next 10 minutes or less going through what the yield curve is, what the inverted yield curve is, what it all means, and then give you something that you can digest, replay, understand, so that you have a good general working knowledge of this really important concept in finance and economics. So with that, let's dive in. So the yield curve, what they're talking about is the interest rates on the United States Treasury bonds. So there are U.S. Treasury bonds are issued in lots of different maturities, the shortest being 1 month, the longest being 30 years. Okay, so the U.S. Treasury issues bonds between 1 month in length when they mature and then 30 years until they mature. 30 years being the long, 1 month being the short. So far, so good. What you may not know and you may not be aware of is that investment nerds, finance nerds, econ nerds, just like me, pay really close attention to how much the 1 month treasury and that 30-year treasury and all the other months in between, how much those treasuries are paying. And if you map it out in terms of the 1 month pays this much, and then the 2 month and 3 month and 1 year and 2 year and 5 year, if you map out all those U.S. treasuries on a graph, you'll come up with a yield curve, a line. And what you normally want to see in a normally healthy economy is that the Treasury is paying less interest on those short-term bonds, and they're paying more interest on the long-term bonds. Why? Well, if you're going to hold your money up and tie it up for a long period of time, like 30 years, you better pay me more than if you're going to tie it up for a month. So you would expect in a normal, healthy economy, a nice gradual, they call it positive sloping yield curve, where it looks like you're climbing a hill. That's what you want to see. So I put together a chart direct from the U.S. Treasury's website, which shows that January 2017, we had a normal positive sloping yield curve, where the 1 month U.S. Treasury was paying 0.5% or 0.5%, and the 30-year U.S. Treasury was paying 3%. And there's a nice positive sloping hill to climb yield curve where the longer the bond, the more it paid, and that was the sign of one sign of a healthy economy. Great, terrific, fantastic. If you fast forward to August of 2019, what you'll see is that 1 month is over 2%, and the 10-year, which right now is somewhere around 1.5, 1.4, depending upon the day with which we're recording it, it's somewhere between 1.45 and 1.5. And you're making more on your short-term treasuries than you are on your longer-term treasuries. It's inverted. And the inversion is critical because it tends to mean a bunch of things about the U.S. economy, which we're going to get into right now. One of the things that people look at is, well, what's the difference between that 10-year U.S. Treasury, which again today is somewhere around 1.5%, and the 2-year U.S. Treasury? What's the difference in terms of which one's paying more? And it's significant because that number finally hit zero, like they were paying the same. 2-year Treasury and a 10-year Treasury, it was like, whoa. And when that started to happen, people automatically started to fear that a recession was coming, which is unfortunate, but it's shocking. And we've been talking about this inverted yield curve. And if you're a regular podcast listener, you know this. We've been talking about this inverted yield curve for at least 9 months. And the fact that it looks like it's going to happen, here it comes, and you can see it. You can see this trend, which started easily the beginning of 2018 finally came to fruition here recently. And if you look, that's the 2-year Treasury versus the 10-year. And if you look at the 3-month Treasury versus the 10-year Treasury, that was even more dramatic, where you can really see this dramatic change. And I'm happy to share these slides with you. Just certainly send us an email at info@hh-wm.com and we'll send these things out to you right away. But you can see that once it started to get negative, which was right around March of this year, it improved a little bit and then got negative again in really that June time period, tried to improve in July, and then here we go in August, it got a heck of a lot worse, meaning more negative, the difference between the short-term and the long-term Treasury. So why do people care? Because this inverted yield curve typically signals trouble. Here's a huge, huge note. Pay attention. Not every economic indicator is perfect. And an inverted yield curve is not a perfect economic indicator. But an inverted yield curve has signaled 9 out of the past 10 recessions. Meaning, I'll take it a step further. You'll hear that statistic. But what that really means is that we've had 10 inverted yield curves and 9 recessions. Meaning, for every inverted yield curve, it's a definite signal. But one time we had an inverted yield curve that didn't come with a recession. And this could be an inverted yield curve, which we have right now, that doesn't come with a recession. But now you're working with historically speaking, since the 50s, a 90% probability that it does mean a recession's coming. And it's interesting because the question becomes is how long will it be once we get this inverted yield curve to when a recession starts? And the answers are all over the board if you go back to the 50s. In some cases, once an inverted yield curve happens, it's 21 months before a recession. Sometimes when we get an inverted yield curve, it's -1 month before we get a recession. How it could be 21 months or -1 month? The answer is yes. The average is 6 months. Well, so what am I supposed to do? Is it going to be 6 months? The point is we don't know, but it's a signal that you can be reasonably sure that's going to bring some difficult times ahead. And I've got a really nice chart that looks back into all the prior inverted yield curves, including this one, to say, when does the market usually peak? And when does the economy normally fall into a recession? To give you a greater understanding for what the historical landscape has been. And like recessions, the peak of the stock market usually happens after an inverted yield curve. Well, here we are. We've had the inverted yield curve. We just had a new peak of the market. So you have to ask the question, is that it? Is that it? So was that the market high? And are now we facing a recession? People still don't understand. Even after hearing all this, they say, well, but why? Why does it? I still don't understand. Great. So, okay, inverted yield curve. I know what you mean now. I know what a yield curve is. I know it's the U.S. Treasury, and I get it. I can visualize the mountain graph. I can visualize the inverted yield curve. Okay, I got it. But what's the big deal? The big deal is that banks borrow money short term, and they lend money long term. So if they cost them, I'm going to make this up, but 2.5% to borrow, and they can lend it out at 1.5%, you don't have to be an economics wizard to know what a bank will do when the cost to borrow is greater than the cost that they can loan the money out at. They won't lend. And what happens when banks don't lend? The economy slows down. Ta-da! So that's it. That's it. If you understand everything that I just said, and if you commit that to memory, there's a huge part of economic theory that you have now just mastered. We should send you a little patch, a little commendment of achievement. There's a lot of critical things that we hope to educate you on, and this is something that we absolutely want to make sure that you know, because you do need to know it. So with that, hopefully now you have a working understanding of what the yield curve is. You understand that it should be positive sloping. Short-term treasury rates should be lower, hopefully, than longer-term rates and in a normal economy. But yet, when things start to get a little weird, and there's a few reasons why things are weird, I'll talk about that for just a second, that there's economic circumstances where, oh no, short-term treasury rates are actually higher than longer-term treasury rates, which can cause some problems for banks and lending institutions. One of the things that we don't know, I'm going to leave you with this, and we'll have to do a whole little education session on this, is are our treasury rates being impacted unusually so by the influence of foreign money coming from overseas and buying our U.S. treasuries and pushing the yields down? Is that why we're having an inverted yield curve? Is trouble with the fact that Germany, that just last week issued their first 30-year German government bond at a 0% rate of interest that was so sought after that people paid more than asking price. It was a negative yielding 30-year treasury, German treasury bond. So what would you rather own? Would you rather own a 2% U.S. treasury or a negative German 30? I think the answer is obvious. So if you're looking to put your money somewhere, maybe, just maybe, a huge disproportionate amount of that money that normally would go to those kinds of German bonds or Swiss bonds or most of the developed world outside the United States bonds, Japan and Denmark, those places all have negative interest rates. So ask yourself, where would you put your money? Would you want to earn a negative rate of return or something positive in the United States? And maybe that's what's drawing our interest rates down. That's what's inverting our yield curve. And maybe this is no big deal. You'll have to hear more about that in our market outlook, which will be coming up here in the next number of weeks. If you have any questions, send us an email at info@hh-wm.com. This is Michael Carlin, president of Henry & Horn Wealth Management, with your Manage the Funds podcast on the inverted yield curve. Thanks and have a great day. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities, member of FINRA and SIPC.